Yes.
My name is Roger Prince. I'm a senior manager at Berry Dunn McNeil and Parker, and we're a large regional accounting firm, and I've been there about 20 years. I'm a tax specialist, and I'm a specialist in employee benefits. And you may be thinking, well, wait a minute, I understand why the insurers are here and why Mitchell's here, but how did this guy weasel his way into this thing? And think about it. The Affordable Care Act, and maybe you may not know this, is primarily a tax act. It's the largest tax act Congress has passed since the 1986 Tax Reform Act of President Reagan. And that was a landmark tax act. There's an incredible amount of tax in here. And what I'm running into with a lot of clients is they're kind of figuring it out now that I have to talk to my insurer, but I'm probably going to have to talk to somebody, either my lawyer or my tax guy, who understands the tax aspects, because a lot of the rules you're going to hear about with respect to individual requirements and employer requirements are tax rules, and they're all controlled by the statute, you know, the Internal Revenue Code and the regulations. So I see a lot of misconceptions out there about how different provisions work, and it does come down to tax. And I'm not trying to overblow the whole thing, but that's why I'm here. So let's take a look for a moment. Wendy mentioned a good fact earlier. She said, you know, out of, what is it, 44,000 are enrolled, about 90% of those receive some kind of help. And the way it works under the Act is if a individual qualifies for a subsidy, first, dependent upon their income. And it comes down to whether or not their household income is between 100% and 400% of the federal poverty level. And I'm just showing you up here what the income levels are. For an individual in 2014, almost $47,000. For a family of 4 in Maine, $95,000. So think, what percentage of families of 4 in Maine make more than $95,000 household income? It's a low percentage. So what I always try to explain to people is most of your employees, if you're a small employer, are going to qualify for federal subsidy. And you might think, well then, so what? Well, the difference is you may have employees coming to you. These are the questions I'm getting, saying, why are you offering me coverage? You're screwing me. I can't go to the exchange and get a federal subsidy because of you. So something you are doing at your cost that's supposed to be a benefit all of a sudden is perceived as a detriment. I have seen this again and again, because the employees aren't always well informed either. So here it is. To be eligible for subsidy, you may not be eligible for Medicaid or Medicare, but the big one is you may not be eligible for employer coverage. As long as the offer of employer coverage, and I get to this in the next slide, is affordable and provides a minimum value. Okay? Most policies in Maine provide minimum value. If I offer coverage to my employees, and it's employer pay all for single coverage, but employee pay all for family coverage, is that affordable? Anyone want to, yes, no?
No.
It is, and that's a great answer, because it segues right into what I'm going to explain. The affordability standard is odd, and a lot of consumer groups didn't like this because the affordability standard is determined strictly by how much your employees must pay for single coverage. In general, the rule is you can't make them pay more than 9.5% of their household income for their own single coverage. What you charge for family coverage makes no difference whatsoever. Okay? So what some clients are doing is they're providing affordable single coverage, but they're not providing affordable family coverage. And you might think, well then so what? I'll just do affordable family coverage. I mean, I'll do affordable coverage, I'll do, you know, employee pay all. But hey, employee, if you want family coverage, I'm offering it, you pay all, or you go to exchange. But by just offering family coverage, I've precluded my employee's spouse from getting a subsidy. Okay, because that spouse has received an offer of affordable coverage based upon that single standard. Does that make sense? So what we've explained to some employers is, and this depends upon carriers too, is you may want to offer coverage to your employees, and it depends on what kind of coverage you can get, but employee and dependent only, no spousal coverage. At least then the spouse has the option of going to the exchange and maybe qualifying for a subsidy dependent upon income. So that's just one thing to think about. Mitchell mentioned, you know, who's affected by all of this. Right now in 2014, the only people affected are individuals because we have the individual mandate in place. And people signed up in Maine. And when we file our Forms 1040 for 2014, later after year end, we're all going to have to fill out a new part of our Form 1040, which talks about whether or not you are eligible for coverage, and did you have minimum affordable coverage? And if you, minimum essential coverage, if you weren't covered, you are going to pay a tax penalty, which will reduce your refund, okay? So it's a tax penalty you're going to end up paying. And think about this is going to be kind of a mess, I think. People who did receive subsidies this year in 2014 will have to do a reconciliation of those subsidies on their 2014 taxes. So those subsidies were based upon prior year events, because no one, and you kind of look forward, but what if you got a raise during 2014 so your income went way up? Well, now you've received an excess subsidy. So you're going to have to pay that back to the government with your tax return, and again, reduce any potential refund. So it really hits individuals on their tax returns. And I think a lot of people are going to be surprised by that. We mentioned employers. Small employers are 49 employees or less, 49 full-time and full-time equivalent employees. But what has been done for 2015 is a special transition rule said, we're going to, just had to look over here, we're going to delay all of this for medium-sized employers. That's not the word in the statute, but that's what's happened. Basically, employers with between 50 and 99 full-time and full-time equivalent employees. So that's good news. I know a couple of people raised their hands. We said anyone with over 50. Well, if you have less than 100, you're still golden in essence for 2015, although there are some transition rules you have to meet. You can't be eligible by reducing your workforce. You can't be eligible by reducing coverage. And the rules get complex and I won't go into them, but suffice it to say that if you're 80 employee employer, you've got to look at these rules carefully because you're going to have to certify that you meet various conditions to get this 1 year additional exemption. Okay, so talk to your advisor is all I'm trying to point out. This is important, I think. We've had a lot of talk from small clients about this. What are the cost benefits of me offering coverage to my employees in essence? If you offer group coverage, the benefits to your employees are quite remarkable. You can offer the coverage to them and it's tax-free. If they have an employee portion that they have to pay and they have a cafeteria plan, they pay that pre-tax, both in terms of income tax and payroll tax. And you can also provide, pre-tax health reimbursement arrangements and so forth. Now let's say you decide to abandon coverage and send everyone to the exchange, and some people are doing that. I mentioned before, okay, they may be eligible for a subsidy, and that is also tax-free. However, let's say you decide, I'm going to give them a bonus instead of providing coverage. I used to provide coverage at $2,500 a year. I'm going to give them a $2,500 bonus. Now that's taxable for them, okay? So their employer money is taxable, and the money they pay the exchange or a private carrier for their coverage is after-tax dollars now. So everything for them is after tax. So there's a tax cost to an employee to go off an employer plan. And there is one way to beat that, and I'm going to show it to you. What we used to see a lot in the individual market or in the small employer market, a lot of our employers told employees to go out and buy individual policies and we'll reimburse you for those pre-tax. That was allowed under the tax law. And in 2013, the IRS issued a notice saying, no more, we're not going to allow you to do that. If people want individual coverage, we will help them on the exchange if they qualify, but you cannot use pre-tax employer dollars to let employees buy individual policies. I just want to check my notes here because I sometimes get ahead of myself. How am I doing on time, Wendy? Well,
8 minutes.
Wow. Okay. I want to bring up one thing here. I've had a client call last week, and I worked with a lot with a client in New Hampshire the week before. There are about 3 or 4 national firms that are saying we have found a way to skin this cat. Zane Benefits is the most prominent of all of them. Basically, Zane is saying on their website and selling that they have a health reimbursement plan, an HRP versus a health reimbursement arrangement, that allows you, the employer, to sign up with them. Your employees buy individual policies, and your contributions to their reimbursement arrangement are pre-tax. And we've looked at this closely, and I don't think it works. And neither do any other advisors nationally, but we asked them for a legal opinion and we haven't got it. But just in case you come across those kinds of claims, really look at them carefully, because the penalties of non-compliance on this are substantial. So you just be careful you see that. Here's something that kind of works, and this isn't going to work for everyone, but the one way to get pre-tax dollars for individual policies is through a health savings account. All right, say I'm an employer and I have 18 employees. And I've offered coverage, but I want to do something different. I could send them out on their own and say, look, if you sign up for a high deductible health plan, individual policy, either outside the exchange or inside the exchange, because there are now HSA eligible plans on Maine's exchange, then I will contribute X dollars to your health savings account this year. Okay, and my contribution to your health savings account is totally tax-free. And they, if they go to the exchange, may qualify for a governmental subsidy. So it's kind of a unique way. Now, one of the dangers there, or one of the things you've got to be careful about, is their HSA cannot be used to fund premiums. So the only thing it's going to be good for is out-of-pocket costs. But of course, the whole idea of a high deductible plan is, because it's high deductible, the premium's been driven down, resulting in a out-of-pocket potential, or likelihood, really. So if you're funding that out-of-pocket into an HSA, it may work. I just haven't seen a lot of people talking about that, but we think it works, you know, and it's a nice idea. I'm going to move into this credit. We don't have to spend too much time on it, but the small employer healthcare tax credit can be a wonderful tool for those people that qualify, but it's not easy to qualify. Look at the standards. You have to have 25 or fewer full-time equivalents, and we'll get into that to qualify. Your average annual wages have to be less than just a little over $50,000. Here's another one. You have to be paying more than 50% of the premiums. That's a high employer pay rate, at least compared to what I generally see from our clients. Finally, starting this year, you must use SHOP, which Mitchell mentioned earlier. That's the exchange small employer program. And this is a new limit, again, starting this year. If you get this credit, you can only do it for 2 consecutive tax years. It's not unlimited anymore. Because it is a great credit. You can see what it equals. 50% of the premiums you pay, and if you're a not-for-profit, it's 35%. And by the way, if you're not-for-profit, you have to be a 501c entity in order to qualify for this. But so this is a narrow benefit, but it can be tremendous for the right entity. Just very quickly, if you want to maximize the credit at the 50% I showed you, you have to be really small, less than 10, or 10 or less, I should say, and average wages under 25,000. And then it phases out when as you start to grow in size as an employer. But again, we made this because it's one of the biggest tax benefits of the Act. Here's how you determine full-time equivalents. You take your total hours and you divide by 2080. You don't look at overtime in essence. And by the way, you exclude your typical owners, sole proprietors, 2% shareholders and partners and so forth. Average annual wages, not very hard to figure that out. I'm not going to spend much time there. What I do want to spend a little bit of time on is this reporting. The reason the entire employer penalty provisions were put off for 2014 was because this reporting was not in place. I don't know if you remember, but back in July of 2013, the Obama administration announced a 1-year delay for the entire employer provision. So that's like right now in 2014, we're in this first year of delay. Next year, as I told you, there's a further delay for medium-sized employers. Okay. However, starting on 1/1/2015, at least today, large employers, 100 or more people, are going to have to comply with the pay or play provisions. And that's what the interesting part is. I'm not getting a lot of calls from those people yet. I'm still hearing from small employers. The large employer, I think there's going to be a tsunami of activity starting around November 1. It's just, we're all deadline driven, and a lot of employers, large employers, haven't really looked at this yet. But small employers can be hit by these reporting rules. The first rule says you have to report minimum essential coverage. The section I refer to up there, 6055, is an Internal Revenue Code section. And the only reason I point that out is if you offer self-insured plan, no matter what size you are, 5 employees up to 5,000, you have to do that reporting. Okay, and you're going to have to do it starting 4/60/15, filing in, what did I say, 60/15? Starting in 2015, but reporting in 2016. So that's any size employer. And then down here, this is where large employers have to report what kind of coverage they're offering to see whether or not they're subject to penalty. And while medium-sized employers have a break from the penalty rules for 2015, they don't have a break from the reporting rules. So in 2016, January and February, they're going to have to fill out these reports. And remember I said you had to certify whether or not you qualify for that 1-year exception, that's where you'll do that. And these reports are just like W-2s in essence. They're 1095 forms, it's a new form, and what they're going to look like is a W-2 but with a lot more information on it. The amount of information that's going to be required is incredible, and it's going to be a real burdensome activity, and a lot of the payroll companies are really working hard to try to get systems in place to provide the information, because it seems natural it would be a payroll function. That's all I have.
You want to ask if there are technical or...
Sure. Are there any tax techno?
Last slide.
Yeah.
Can we go back to the last slide?
Yeah, I'm sorry. I just did something here. What did I do?
Oh, I'm sorry, I was moving.
That's all right. Mitchell's fast on the trigger. He's giving me the hook. Yes, Ed.
Okay, so you're saying any size employer with a self-insured plan?
Yes.
And is that section applicable only to self-insured plans?
Yes. As far as what's going to happen, this first set of reporting up here, let's say I'm any size employer with an insured plan. My insurance company is going to do that report because it's reporting the insurance coverage in general that's being offered. But if I'm self-insured, Barry Dunn is self-insured, regardless of my size, my TPA is going to do that report. We're going to have to file it. Yes, sir.
Yeah, Roger, nice job per usual, but I just wanted to see if you could talk about HRA. You talked about the HSA as pre-tax, but obviously that's going to benefit those above 250%. Those below 250 that have access to a cost share reduction. The HSA plan might not be in their best interest, right, if they're going out with the individual exchange. So the HRA could be the better avenue. Can you talk about that?
Yeah, here's the point this gentleman's bringing up. He mentioned 250%. If you earn less than, and I may have this a little bit wrong, so help me out. If you earn less than 250% of the federal poverty level, then besides the subsidy I spoke about, you may also qualify for out-of-pocket assistance. It's another form of federal assistance, pre-tax, which is good. What he was indicating was if you have an HSA that may make you ineligible for that assistance. The trouble is if you try to do it instead with an HRA, health reimbursement arrangement, what I was showing was a case where you send your employees out and they buy individual policies. In that notice I spoke about earlier, the IRS said you can't do an HRA combined with individual policies anymore. It used to be done all the time. You just can't do it, period. So you're right. It's a tough call. I hear what you're saying, and I don't know what limit. I just don't know. That's a good. You'd have to take a look at that with your advisor, whether it's because the HRAs are out.
May I ask one more question?
Yes.
Now, Mitchell is quite optimistic about the shop coming into effect in 2014. Can I ask you what your view is, and then what you think the view is of the national firms?
Well, the shop is coming into place in a lot of other places around the country. In essence, to some extent, shop is in place now in Maine, except you had to apply through your broker. It wasn't available electronically. I think it's going to happen. I really do.
It's going to happen in November 14th.
Yes. Yeah.
So I'll just add to that per Ed's point, it's not certain. We thought a lot of things last year at this time that ended up not happening on schedule, so to speak. But again, because 5 states have already launched the electronic enrollment as a pilot, that's the reason for my guarded optimism.
Okay.
So we'll see what happens.
Yeah.
I'll take that.
I thought you wanted my notes.
This one more technical question, and then we'll move on.
The healthcare tax credit, you're talking about the shop, and you said you had to start using it in 2014. So if you did not, as an employer, offer coverage in 2014, can you start offering it in 2015 and be eligible for healthcare tax?
Yes, that's a great question. The slide's a little ambiguous there, you're right.
Okay. And also the excluded, you said something about employers not being included in that, or the business owner, are they included in that calculation of the average wage?
No, they're not included in the count or the average wage, which is helpful.
Yes.